Hello and good evening, everyone. Today's webinar topic is how to build a long-term portfolio. So for this, we have with us Dipesh Raghav sir. Dipesh Raghav sir is a SEBI registered investment advisor and an alumnus of the Indian Institute of Management Lucknow and the Indian Institute of Information Technology Allahabad. With over a decade of experience, Sir has been helping investors make smarter financial decisions through commission-free and conflict-free advice, with a strong focus on goal-based financial planning. Dipesh investment philosophy centers on clarity, discipline, and long-term thinking, principles that are critical to build a resilient portfolio. Dipesh regularly shares his insights on personal finance through leading business publications and through his websites by the name www.personalfinanceplan.in, where Sir writes extensively on portfolio construction and investment management. Now, a short glimpse about NISM. NISM is a public trust established in 2006 by the SEBI, the regulator of the securities markets in India. The institute carries out a wide range of capacity building activities at various levels, aims at enhancing the quality standards in securities markets. Before beginning the session, I would like to request all the participants to note some important points. First, question will be taken at the end during the Q&A segment. Second, all participants will receive a participation certificate within 3 to 4 working days. Third, the recording of this session will be available on the NISM's YouTube channel. Now I request Dipesh sir to begin with this session.
Thank you, Sahil. A very warm welcome to all the participants. It's very nice of you to join at 4 p.m. on a weekday. So, the topic of today's presentation is how to build a long-term portfolio. Um, I'll divide this presentation into two parts. In the first part, we'll focus on some of the disciplinary, behavioral aspects of investing. Essentially, how to think about a long-term portfolio. In the second half of the presentation, we will look at how to actually build a long-term portfolio for your long-term goals. So we have a lot of ground to cover. Let's dive right in. So this is about NISM. I have also already spoken about this, so I'll skip this. Um, Disclaimer, what we discussed today or what I shared today is investor education. It is not investment advice. This is my approach to portfolio construction. This is my opinion. May not be suitable for everyone. It may not be suitable for you. So take whatever I say with a pinch of salt. What I suggest is my approach to portfolio construction. It may or may not be suitable to you. Again, registration granted by SEBI and the membership of BSE does not guarantee the performance of the intermediary, nor does it provide any assurance of returns to the investors. Investment in securities markets are subject to market risks. Please read the related documents carefully before investing. And any securities, ETFs, indices that find mention in this presentation are only for the illustration purposes and are not recommended or fair enough. So what is the first thing that comes to our mind when we think about a long-term portfolio? I think the first thing is that we need a big portfolio. Now, what constitutes big is a bit subjective, but yes, we want a big portfolio, whether it is 1 CR, 2 CR, 5 CR, 50 lakhs. I don't know. It depends. It varies from investor to investor, but we want a big portfolio. We want good returns, and we also do not want a high volatility. So we want good returns at a lower volatility. But what actually happens in life? There is no free lunch. If there is a product that shows you prospect of a return greater than the returns from a bank fixed deposit, then you have to be prepared for risk. It's a double-edged sword. So if a bank FD offers you 7% and there is a product which you believe will offer you 12%, you must also be prepared for, let's say, minus 5% return from that product. So there is no free lunch. A higher return will most likely, in most cases, will come only at a higher risk. Higher risk means, of course, risk is volatility, but it could also be loss of your capital. Building a big portfolio is not difficult, but it is not easy either. So, for instance, just to give an example, you for you to get to if you invest rupees 10,000 per month, and assuming you earn return of 10% per annum on that investment, your portfolio will get to 1 CR in about 20 to 23 years. So yes, you can get there, right? So it's not difficult, but it's not easy either. Earning 10%, so usually we just focus on the destination, right? But in many cases, people err during their journey. So they go into a product, assume that they learn 10, 12, 15%, 20%, but then, and it's quite possible that that product may actually offer you those kind of returns over the long term. But as I said, there is no free lunch. It's possible that in the interim, you might earn lower returns as well. Will you be able to maintain that discipline during those times? That is the key. So it's not difficult. It's not very easy either. Then there are certain behavioral biases that we have. One of the very common being comparing our portfolio returns with others. So you may be earning the product where you have invested in may be giving you 10 to 12% per annum. But if your colleague or your neighbor is earning 15% per annum, you will automatically become dissatisfied with your rate of return. So these are some of the aspects which, even though the task is not very difficult, if you invest for a long enough period, your portfolio will eventually become big. You just have to avoid those mistakes. What should we do? I think the first thing that most of us must do is financial planning. Financial planning will give us answers with respect to, for instance, what is big? What is a big enough portfolio? Is it 50 lakhs? Is it 1 CR? It is 2 CR. Essentially, a big enough portfolio will be a portfolio, or the size of a big enough portfolio should be such that it should provide for all your long-term goals, which could be retirement, kids' education, purchase of house, parental care, travel, purchase of a car. So it could be anything under the sun. But a big portfolio should be a portfolio sufficient enough to meet all your long-term goals. Now, these are the kind of answers that you will get when you do financial planning. It's not difficult, it's very simple. Most of us simply focus on the returns part. We focus on what we tend not to focus on what really matters. Yeah. Then the power of compounding. I think everybody knows this. I'm sure you have also heard about power of compounding multiple times at numerous forums, books, blogs. But there's something sometimes a lot of people struggle to relate to or appreciate. That's why I mentioned earlier. Everybody wants to get rich and get rich quickly. So power of compounding shows you that you can get rich by investing with a lot of purpose, investing regularly, but it may not happen so quickly. And sometimes in that zeal to get there quickly, we make mistakes. We chase opportunities that we should not have chased. And that brings to the next point, rational expectations. Yes, over the past 3, 4, 5 years have been really good for the equity markets, especially since the first wave of COVID. So many of us who have entered the markets over the past 4, 5 years perhaps are used to seeing 15, 20, 25% returns from some of your investments. But then this is just a snapshot in time. We have to go back and read market history to understand what have the markets given over the long term. And that perhaps will rationalize some of the expectations that you have from your investments. So this chart has three pieces of info. So topic the first rupees 1 CR is the hardest to get. So if you look here, you see a sequence of numbers 23, 7, 4, 3, 2, 1, 1. What does this represent? So again, if you invest rupees 10,000 per month, uh, and you earn 10% per annum, you do this regularly, then you will get to your first CR in 23 years. The second CR, or you will move from 1 CR to 2 CR in just over next 7 years. In 30th year, you will have 30 lakhs. So 30 CR, 2 CR. In 34th year, you have 3 CR. In 37th year, you will have 4 CR. In 39th year, you will have 5 CR. And then every year, you will add a CR to your portfolio. Now, 1 CR is a lot of money. I understand inflation will eat into the corpus value, but still, 1 CR per annum simply because you have been investing rupees 10,000 per month for the last 35 years. Imagine if you're investing more. These numbers will come sooner. If you're investing 20,000 per month, perhaps this number will come in about 12 years. And then likewise. Most of us, when we look at the compounding, so this is the equation of compounding. The final value equal to P, which is the invested amount, into 1 plus rate of return to the power N, which is the number of years. Most of us focus on the R part. I should make an investment that gives me a very good rate of return. But we tend not to focus on the P part, which is the amount of investment. Now look at the chart on the right side. So the orange line is for the portfolio where you invest 10,000 per annum at 12% per annum, 12 per month at 12% per annum, where the portfolio gives you 12% per annum. The green line is for portfolio 2, where you invest 20,000 per annum, double the amount, but the return is 2% less. But if you see in this, it will take portfolio 1, despite earning 2% high, 2% is not a small rate of return. It will take portfolio 1 almost 40 years to get to the size of portfolio 2, where you are investing double the amount, even though you are earning a lower rate of return, but you are investing more. And that's what is very critical. Invest more. So we tend to focus on the returns, but the size of the investment also matters. So in the 48th year, portfolio 1 will surpass portfolio 2, despite earning a higher rate of return. Now we come to the portfolio construction per se. So what should be the approach? By the way, the approach that I consider here is for the long-term portfolio. You may have to think slightly differently if you are structuring your portfolio for some of the short-term goals. So it's a three-step process. First step, and which is the bedrock of portfolio construction, it is the asset allocation. What is asset allocation? Asset allocation is how you divide your portfolio among various assets. What could be those assets? It could be stocks, equity, one. Second could be fixed income, debt. Third could be gold. Fourth could be real estate. Then you could have certain alternative assets, art, or if somebody has a bent towards let's say some of the digital assets. So those could also be, you could consider those. Every asset will have a different risk return profile. For instance, equities can offer you better returns than debt, but then those higher returns, potentially higher returns, will also come at slightly or a much higher volatility. Then we once we decide upon the asset, okay, if we decide we'll have say 50% equity, 50% debt, then you move on to the sub allocation within the assets. Let's take example of equity assets, right? So and a way of looking at sub allocation could be how much should I have in large caps, mid caps, small caps, or factor products or hybrid products. This is the sub allocation. Thereafter, once that sub-allocation is done, so let's say within my equity portfolio, I want to allocate 50% to large caps. In the large cap space, which investment should we choose? Which stocks or which mutual fund should I choose for the portfolio? Then last step is the regular review and the rebalancing. You have made certain choices in the step 1 and 2, asset allocation and the sub allocation and selecting investments, but you need to review this portfolio on a regular basis. So you had a certain outlook about the markets. You had you thought certain sectors or certain kinds of stocks will do well, but your hypothesis or your outlook towards various spectrums of the markets may change over a period of time. So you need to review portfolio on a regular basis. Then, and of course, the rebalancing part. So you might, let's say you start with 50-50 allocation to equity and debt. Over a period of time, over the next 1 year, equity investments do really well, and let's say grow by 20% over the next 1 year. Debt fixed income investments, say give only 5%. So it's possible after 1 year, your asset allocation, target allocation was, you started 50-50, target allocation was also 50-50. But because of the market movements, now allocation has moved to, let's say, 55% to equities and 45% to debt. Then you rebalance, you bring it back to 50-50 or at regular intervals. We'll also pick up this point during the later portion of this presentation. Why asset allocation? Very clearly, diversification with uh, by adding uncorrelated assets to your portfolio. You reduce portfolio volatility, you improve risk-adjusted returns. Most importantly, you keep your mental sanity intact. So, you know, uh, I'm sure at least some of you might have seen the kind of fall that we saw in the first wave of COVID. The bellwether indices fell about 40%. So if you have 100% of your portfolio in, say, equities, you would have lost almost 40% within a few weeks. I'm not sure. It's easy to say that over the long term things will be fine, so I'm okay. But I'm not sure how many people would have been able to, keep their mental sanity intact or not make choices which they will go on to regret later. So I've seen it with many investors. They start with a certain allocation, a very aggressive allocation, but when the markets fall, they either stop their SIPs or they, somehow simply take out money from the riskier assets, which let's say are equity, stocks and equity funds, and move it to safer assets. Then suddenly markets bounce back, but they have already taken money out from the equity assets, so they don't get the full benefit of the markets bounce back. In certain cases, you could also earn potentially higher returns. There's no guess. So, by diversifying the portfolio, you can very clearly, it's easy to see that you will be able to lower portfolio volatility. But in certain cases, by rebalancing portfolio at regular intervals, it's quite possible that you might be able to earn higher returns at a lower volatility as well. That's something you can in some parlance is also called rebalancing bonus. And as I in one of the earlier slides I mentioned, investment journey also matters, right? So it's easy to say over the last 30 years, XYZ stock or XYZ mutual fund has given 15-20% returns per annum returns. But how many investors were able to stick with that particular investment for the entire tenure of 30 years? Not many. So when we witness a lot of volatility, some of these basic things or thought process goes for a toss. What is the best asset allocation? Again, no objective answer. We have also discussed about the more common asset classes. There is no one size fits all solution. What might be a good asset allocation for me may not be right for you. Right. Sometimes we think of asset allocation. Acha, if you're a conservative investor, you should have say 20% in equities, 80% in debt. Right now, assuming there are only two assets, right now I'm leaving out gold and real estate from this discussion, but they should also be part of the portfolio. Average a balanced portfolio could be, let's say, something like 40-60 or 50-50 equity debt. An aggressive portfolio could be 70-30 or 80-20. But again, that's how I think about this. For you, even 50-50 or 40-60 equity debt could be a very aggressive portfolio. Right? So it's a function of your risk profile, your staking ability, your risk appetite, and of course the financial goals. Financial planning was the first part of should be the first step that you must take while constructing your long-term portfolio. So financial goals, if let's say your goals are short-term goals, you should be investing rather conservatively. If your goals are long term, then you can think of adding risk to the portfolio. How much risk you should add depends again on your risk profile. And again, risk appetite also is in a way a self discovery process. I met many investors who initially thought they were very conservative, but then after interacting with them over the next few years, I could see that I could sense or I could feel that they are not as conservative as they were, and vice versa too. Some people gave an impression that they were very, very aggressive investors, but that did not turn out to be the case. So when the markets fell, they were perhaps the first ones to get worried. Now, assuming you have decided what will be your asset allocation. So let's say for me, a balance is like something like a 50-50. You allocate 50% to equity, 50% to debt. Again, I'm not bringing in gold and real estate here, because gold is gold. Whichever way you invest, there may be some issues here or there, but you get what you have. So you invest in gold. So for now, for the purpose of this presentation, let's focus on the equity and debt portfolios. Yeah. So I again, this is my opinion. So I tend to divide my or rather I tend to view my equity portfolios in core and satellite. Now this terminology is used in different ways at different places, but I'll tell you what I mean by core and satellite portfolios. So with the core portfolio, the aim is to generate market matching returns. And what better way to do that than by using index funds? Passive cap based index funds. So you could look at the bellwether indices, or you could look at certain broader indices. Like say, so bellwether is Nifty 50 Sensex. Broader indices could be Nifty large mid cap 250. It could be Nifty 500. It could be Nifty 100 as well. So Nifty 100 is not as broad based, but yes, that depends. Yeah. So you focus on generating market matching returns. The aim here is, and why do we do that? We do that because at least I appreciate that markets are not easy to beat. And perhaps that also explains the success of ETFs and index funds the world over, not just in India. Not just in India, the world over. You will find that index funds are not so easy to beat. Beat consistently over the medium to long term. So by now, when this is the premise, then clearly we should have some allocation to the market returns. So that's why the core portfolio is there. Again, by having index funds in the portfolio, we ensure that we do not underperform the market. Because investing is also as much as a matter of skill as it is a matter of discipline. So when we see that we are underperforming, we tend to worry, we tend to make mistakes. So by investing in cap-based index funds, we ensure that we never underperform the market. It also helps us diversify the equity portfolio. How do we do that? So, so for instance, ETF, when I say we should invest in low cost index funds and ETFs, I'm not just referring to domestic funds and ETFs. You can also look at foreign equity index funds, foreign equity ETFs. I understand there are certain restrictions in you know, at least for Asian investors to invest to take exposure to these kind of products. But if possible, you can figure out a way to do that. There are certain products which is still accept investments. You can perhaps consider those, or you can send money abroad under LRS, the Liberalized Remittance Scheme, and take exposure to these kind of products. Now, as humans, as investors, we tend to not be satisfied with, or at least a number of us will not be satisfied with just earning the market matching returns or the market returns. We want to do better, and that's what the satellite portion of your portfolio is. The aim is to generate market beating returns, and that's also the segment of the portfolio where you express your portfolio preferences. So you might, let's say, have you might have an outlook that a certain sector, it could be say pharma, banking, IT, defense. Yeah, it could be anything under the sun, right? So again, this is your portfolio preference or your market outlook. So this is that's where you so this is the segment of the portfolio where you express those preferences. You might also believe that okay, now is the time where large caps may outperform or the mid caps may outperform, or you might want to say okay, I know this is the mutual fund or this is the fund manager who I can trust with my money. So this is also the segment where you can bring in certain actively managed mutual funds. You can invest in PMSs, you can invest in AIFs, you can invest in direct stocks. And there is a new product in again there are no launches as yet, but there is the SIFs are there, so you can think about investing there as well. So core portfolio for generating market matching returns, the satellite portfolio for generating market beating returns. And in some way, satellite portfolio also satisfies her urge for action. Sometimes we are just not comfortable, as I said earlier, in earning the market return. So this portion of the portfolio gives us a chance to have some action in the portfolio. Perhaps putting an SIP of XYZ amount in Nifty 500 index fund is not good enough for you. You want more action. Satellite portfolio is the uh, place for that action. Now the question is how much to allocate? How do we divide? So in the sub allocation, we decided okay, we'll put 50% to equities and 50% to, and we have decided assuming we had given your financial goals and risk profile. You decide that the asset allocation should be 50-50 between equity and debt. But then we have seen that equity portfolio divide between core and satellite. What should be that number? What should be that? So how much do we allocate to core? How much do we allocate to satellite? No, in my opinion, like this is my opinion. There is no, you can choose to play it differently. There should be a decent allocation to the core portfolio. Whether it should be 30% of the equity portfolio, whether it should be 40%, 50%, 60%, I will trust your judgment. Uh, I've seen investors for them for whom the entire portfolio is the core portfolio. So let's say they will have a domestic equity index fund and a foreign equity index fund, or just a domestic equity fund, equity index fund, and they are done. Right. So it depends. Personally, I believe that the allocation there should be decent allocation to core portfolio. I Again, no right or wrong answers here, and that's the part with investments. There are usually no right or wrong answers. But yeah, have a decent allocation, at least 30 to 40% to the core portfolio. And remember, the portfolio is not just about domestic equity funds, right? It's also about taking exposure to different geography, right? By investing in a different geography, so it's called. Let's say you were investing in a broad-based index in US. So that also adds to diversification of the equity portfolio. Since core portfolio, you are banking on the core portfolio to deliver that value, the allocation to the core portfolio must be decent. And very clearly, so you are using satellite portfolio to express your portfolio preferences. But you must always go back and see. You must have spent decent amount of time in selecting products for the satellite portfolio. Core portfolio is fairly simple. You select a couple of index funds and you are done. Now you always have to go back and see whether whether your the performance of the satellite portfolio is worth the effort that you have put in. So if after 5 years you notice that satellite portfolio is giving me the same returns as the core portfolio, either your approach to investments has not worked out well. I mean, of course, it could also be a stroke of luck, or it could be that somehow you were not either you were jumping too much between from fund X to Y. So for whatever reason, you are not able to generate market beating returns. which was the intent of the satellite portfolio. If that turns out, that indeed turns out to be the case, you must go back and see and revisit your allocation to the satellite portfolio. If you're not doing well, then clearly the case for allocating a lot to the satellite portfolio is not there. We are running short on time, so I'll try to rush through some of the remaining slides. Of course, debt is also a portion of the portfolio. Why do we need debt? And there's a question I get a lot over the past, for instance, over the past 15 years, and Nifty has given, let's say, 12% returns. Debt usually gives 6 to 7 to 8% returns. And I am a long-term investor. Why should I even invest in debt? I should, since this money is for long-term portfolio, long-term goals, we should put all of this money into the equity portfolio. Again, I go back to my point. It's not just the destination, it's also the investment journey that matters. If the journey is too rocky, you might jump the ship at just about the wrong time. So we need that for portfolio stability. We need that to provide us comfort during good times. If the market is really doing well. So a common source of worry is that if the market start falling, I will see a lot of loss in the portfolio, right? But when you have a certain allocation to debt, that gives you comfort. Okay, some portion of my portfolio certainly fall, but then I have cushion in the form of the debt portfolio. So it provides comfort during good times. It provides you firepower during bad times. So if the market's indeed correct, how do you take advantage of that market fall? By moving money from debt to equity. So for that also you need money. Now, how do we construct a debt portfolio, right? Should we use the core satellite portfolio here? Yes, we can use it. So uh, a fixed income investment usually carries two types of risks. One is the credit risk, where you give money to someone and that person defaults or that entity defaults. That is called the credit risk. Then there is a classical relationship between the bond prices or the fixed income prices and the interest rates. So when the interest rates go down, bond prices go up, which is good for you. When the interest rates go up, the bond prices fall down, which is bad for you. Right? There is a third element too, which is the liquidity. But yeah, so we have to see. So core portfolio should have investments which have which offer you low credit risk and plus also the low interest rate risk. Good examples which are also looked at could be bank fixed deposits, liquid funds, money market mutual funds. And some of the less liquid investments would be PPF, EPF, Sukanya Samriddhi, RBI floating rate bonds. Right. In the satellite portfolio, we relax on either credit risk or interest rate risk. So one of these or both. Right. So examples could be credit risk debt funds, long duration debt funds, corporate fixed deposits, right? Less liquid could be structured products. Yeah. One thing, usually with risky fixed income investments, when credit risk is about to materialize or is materializing, it's possible that the investments may become illiquid. And we saw that about 5 years ago during the first wave of COVID, where a major fund house stopped redemptions from their debt mutual fund schemes. So be cautious. Now, there is no right or wrong here. Personally, I believe since debt portfolio is debt portfolio adds value in terms of providing me comfort during good times, in fact during bad times as well. And I'm not really looking at my debt portfolio to generate a very high rate of returns. Personally, I would have most of my fixed income debt portfolio in the core portfolio, not so much in the satellite portfolio. But again, to each his own. You can view differently. Now, the third and final step in this process is the regular review and the rebalancing part. Now, here you will see. So I have plotted growth of four portfolios over the almost over last 30 years. Annual portfolio rebalance. So we rebalance on the first day of each calendar year, not financial year, calendar year, right? So the first portfolio is where we put 100% in Nifty 50. Let's assume there is a Nifty 50 index fund which generates returns exactly matching Nifty 50, right? Then there is a portfolio where we put 100% bank FD and assume that bank FD offers you 7%. Now you might say in 1995, bank FD was banks used to offer a much higher rate of return, but fine. For the purpose of exercise, that let's assume that over the last 30 years, You are able to open an FD which gives you 100%, which gives you 7% per annum. Then we have portfolio which is 50% Nifty 50 and 50% bank FD. Half the money is Nifty 50 and half the money is bank FD, and we rebalance every year. So rebalancing is there. So in the first two cases, since they are 100% one single asset, there is no concept of rebalancing. But the next three 50% Nifty 50% bank FD, 60/40 70/30. We have we have we will have regular rebalancing as well. So clearly in this, because of the kind of returns that Nifty 50 has delivered over the past 30 years, this turns out to be the best performer. But there is more than that meets the eye. Right? So if you look at Nifty 50, CAGR is 11.3%. Others are less. Clearly, more the equity, the less the more the equity, you have been able to earn better returns. Again, there is no guarantee. It's quite possible that despite having lower equity in the portfolio, you might have been able to earn a better return. In fact, I did one of such an exercise during in the year 2020, in the middle of 2020. Over a 30-year period, I could see that a 50/50 portfolio, 50/50 Nifty 50 and Bank FD portfolio was outperforming Nifty 50 or Sensex, not Nifty 50, Sensex, over a 30-year period, which is a fairly long time, right? So again, because of how the market trajectory has been, you will see the best returns come in the Nifty 50 PRI portfolio. But I think you also have to look at the standard deviation, which is a measure of volatility, right? Now so look at Nifty 50 PRI, which is which where the standard deviation is 22%. It is two-thirds in portfolio, which is 70/30 equity and debt. Look at the maximum drawdowns. Nifty maximum drawdown is 60%. Look at the other allocation. See, it is the time during these that all that we read goes for a toss. Once you see big drawdowns, no, that's when all the theory, all the market history that you have read somehow goes for a toss, right? So I believe, you know, again, going back, first step was asset allocation, the sub allocation, and the regular review and portfolio rebalancing. All these three steps are extremely important. Rule based investments. Now, many of us invest, and I think markets, if you look at the at least the mutual fund flows or the mutual fund flows, we will see this kind of trend that a lot of us make gut based investments. So suddenly, if the markets are rising, will be quite happy increasing our investments in equity markets, right? When the markets are falling, we'll probably not want to invest as much. And that's where sometimes so this approach, a gut based approach, because first of all, gut based approach cannot be consistent. Today you think X, today you think in a different way. After a few years, after some time you might think in a different way. You might read something which might change your outlook or how you want to approach your portfolio. So this can get really complicated. So by having a rule-based investment, and what could be those rules? Those rules could be about asset allocation. So again, taking an example, let's say I want to have 50% equity, 10% gold, 40% debt in my portfolio. This is the first rule. 50, 10, 40, let's say, right? Then this is the rule about asset allocation. Then the second rule could be sub allocation. Okay, let's say core and satellite, right? I'll have 50% of my portfolio in core portfolio, equity portfolio, and 50% satellite, right? Um, and in the third rule, you decide the frequency, or you decide a certain threshold based rebalancing. Okay, so it could be a child rebalance my portfolio on say 1st of Jan or 1st of April every year. I will rebalance it back to the target asset allocation levels. I might also rebalance it to target sub allocation levels as well. That depends. But write it down. Write down those rules for asset allocation, sub allocation, rebalancing. Also write down how will you rebalance. Will you rebalance at regular intervals, or will you rebalance when there is a threshold breach? For instance, you started with 50-50, and then you decide, okay, I will not touch anything until my equity portfolio reaches 5% on either side. So either if I go to 55, I will bring it back to 50. If it goes to 40, I will bring it back to 50. Yeah. And in fact, that's how you also generate rebalancing bonus. So when it goes to 55, markets have gone up. You are selling you're selling the investment which has gone up, right? And booking some profits. On the other hand, so you are selling high, and when the markets fall, since you have a rule-based approach, you'll be forced to shift some money from debt to equity when the markets have fallen. So let's say when the market equity allocation touches 45, you shift money from debt to equity. So you are buying low, you are selling high and buying low, and there is no other way to make, frankly, the money in markets than buying low and selling high. Right? Stick to those rules. I understand these rules because of our biases, whatever you have read, or and I understand it cannot be perfect, that we will do this. We will just stick to that. Will be a stickler to the for the rules, but at least try to have some discipline. Okay, if not 12 months, I will do this 18 months, but do this. Do not bring your emotions into picture. By having a rule-based approach, we will reduce the damage our investment biases can cause to the portfolio. It's very, very, very easy to invest in a stock that is rising. It's very difficult to invest in a stock that is falling. Right? If you have a rule-based approach, you will perhaps take care of, or your rules will tell you when to sell, when to buy, right? Automate investments, and I think that's also a reason SIP works for most retail investors. You just keep at it. You don't invest manually. Every month the money gets debited from a bank account, it gets invested. You somehow work your way around your SIP investments, right? So if, let's say, you're running an SIP of 20K, no matter how much cash flow pressure you have, you would somehow figure out a way to, or you would somehow make your cash flow sweat, and ensure that that SIP of 20K gets invested in the markets. And that would really help over the long term. Rupees 1,000 invested per month at the rate of 10% per annum. Not a very high rate of return, right? If you do this for 20 years, that 1,000 per month will become 7 lakhs. Assume if you do this with 10,000 per month or 20,000 per month, you can just multiply. Hybrid products. Now, there are certain hybrid products. For instance, you must have heard of asset allocation products, or dynamic asset allocation products. These products internally may have certain rules which drive their investment decisions. So you could also consider these products for your portfolio. But again, the problem is, not all hybrid funds are same. You need to do a much deeper research when you pick up these products for your portfolio. But I want to bring in this point because some of these hybrid products may also be rule-based investments. So this is the last slide. We have 15 minutes. With investments, averages quite good. You don't have to be the best to be happy. It's okay if you are earning 12% and your neighbor is earning 18%. Let that be. So long as 12% is enough for you, you should be happy. Average is good. Most investors don't even earn average. And I'm sure you must have read that report from SEBI where 93% of the derivative traders lose money. Lose money. Forget about earning anything, right? They lose money. So average is also quite good. Don't feel bogged down. The size of the bet matters too. So you don't just have to tick checkbox. I'm also doing a mutual fund SIP. How much? Say 500 per month. Now I'm nobody to send judgment of whether 500 is less or more. The point is, if you're earning, let's say, 50,000 per month, and your SIP is only 500 per month, then there's something wrong. So technically, you are taking a checkbox that you're running a mutual fund SIP. But is that enough? Is that sufficient? These questions also need to be answered. So do not just focus on the rate of return, focus on the size of the investment as well. You may be a conservative investor, So you might feel that, okay, if I have to have a big portfolio, I must, I must make really risky bets. I must, really take a lot of risk. That does not have to be the case. You can make, you can, and mutual, at least I can say that about the mutual funds. They came in all shapes and sizes with varying risk profiles. You can choose products accordingly. But yes, clearly, so you can clearly build a big portfolio with relatively low return investments. But as the math goes, you must invest more. Do that. It's not just about destination, journey also matter. I think this is very, very critical. Everything. So there is a very very a common saying I attribute to a very popular or boxer Mike Tyson. Everybody has a plan until you get punched in the face, right? So you might have read a lot of books. You might have you might have read read a lot of market history, but there are few things that you learn only with experience. And this is what my experience has told me, that journey also matters. That's why I'm not very comfortable with very aggressive portfolios, because eventually there will come a time where you will either lose hope, or you will become disillusioned and might jump the ship at just about the wrong time. So have a portfolio, construct a portfolio that you can live with for life. I mean, you'll probably investing for next 30, 40, 50 years. There's no rush. If you invest long enough for long enough period, then this portfolio will this and invest well, this portfolio will become big. Do not compare with us. In fact, that was my point earlier as well. Do not compare yourself with us. It's okay if somebody, if you own a fund which has given 10% and there's some, XYZ fund which has given 25%, let's be fine. Not everybody can be Usain Bolt or Roger Federer, right? You can't be the best, and you can't be the best all the time. It's possible by stroke of luck or skill, you can you maybe your stock picks or investment picks might turn out to be the best. But assuming that this will happen always, month after month, year after year, that's not how life works. Even even the legendary, perhaps the most popular investor in the world, Warren Buffett, does not beat the market every year. And there have been long periods where his set of investments have lagged the market. So that can happen with so just take these things in your stride and keep investing. I think this applies to most things in life, but I think with investments, simple beats complex. So what I have shared with you, I believe, in my opinion, it's a fairly simple approach, but I think it's better because you know, with investing, simple usually beats. I think most cases, simple will beat complex. You don't have to, and it's not just about the choice of products. It's also about the discipline part. It's also about keeping a mental sanity during adverse market phases. So that's why keeping it simple will make it easier. Will perhaps make it uh, you know uh, simple is not bad, and in my limited opinion, simple will most likely also beat very complex portfolios. And that's also, uh, index funds are rule-based funds, fairly simple, right? And there is an ample evidence that those products are not difficult to beat. So yeah, I think that's pretty much it. Sahil, open to questions.
Yes, sir. Now we can take questions.
How do I view questions? Q and okay.
Yeah, there is a Q&A section.
So I have a retirement comment. So Mr. Jagdish Patra, yeah, I'm an advisor. I cannot give you specific advice, but see, SWP is a complicated product. So SWP is systematic withdrawal plan, just like we have SIP. SWP, in SIP we invest a certain amount every month. In SWP we have a certain corpus in a mutual fund, and then we withdraw from that corpus every year. The problem with SWP, if you are doing this from a volatile product, it's quite possible that when your retirement starts, the market's going must maybe going through a bad phase. So when if that happens, Mr. Patra, it's quite possible that the market volatility might go against you. So in SIP, when the markets are volatile, if the markets fall, you accumulate more units, which helps you over the long term. But during the withdrawal phase, if the markets fall, you will have to sell more units. So you'll have to sell more ownership to generate the same level of income. So I think this can be a very risky approach, and you might want to speak or discuss this with your financial advisor, who might be able to guide you better. Again, there are no right or wrong answers here. I just feel that this is a more this is this slightly risky approach. Siddhant says, "Sir, I've invested in this. Can you recommend any NSM course for beginners?" I think there are multiple courses about mutual funds. About in fact, you can also you know NISM also offers you courses for certification courses for infra professionals. For instance, even as an IA, you have to clear 2 exams. So perhaps you can register for those exams. Again, there may not be any you may not have any plans to register as an investment advisor or as an MF mutual fund distributor, but those courses could be good to take, especially if you're referring to an NSM course of business. Perhaps the NSM team can guide you better on this. So is it easy to beat a clear advisor exam? Uh, um, yeah, it depends. It's not easy. It's not very difficult either. So if you put your if you invest for some time, you will be invest some time. You should be able to clear this. And there are certain SEBI regulations with respect to how much experience you need. Please go through the regulations. As far as I remember, it used to be 5 years, but I think they have reduced the requirement recently. Amit asks, should penny stocks be part of the portfolio? Amit, no strategy, no matter how good, does well all the time. No strategy, no matter how bad, fails all the time, right? So there will be a period where penny stocks will do well. So I would not have penny stocks as part of my portfolio, nor would I recommend that you should have penny stocks in your portfolio. But sometimes you can find deep value stocks in the portfolio if you have that knack for picking good stocks. If you have these skills, knack, time and discipline to time and effort and discipline to research stocks, you can consider for I think 99.9% of the investors, they should not do that. Japesh asks, in terms of best asset allocation, I am surprised that even after COVID, you all are not using cash as an asset class. Cash is king. This was abundantly proven during. Yes, yeah. So cash for me is debt. Perhaps I did not make it amply clear over there. So cash is debt includes cash as well, right? So liquid fund is almost cash. Money market funds are almost cash. FDs are almost cash. So if the markets were to fall, you can you can take advantage of those market falls. I hope that was the question. Real estate clearly is illiquid, but I also know multiple investors who have made very successful real estate investments. Yes, I also understand that real estate is also, no, yeah. So there are gray areas when you invest in real estate, but yeah, to each his own. So if you are a good investor, I mean, some people have knack for or have that eye for investing in good parcels of land, plots or properties. They do well. Mehak asks, as a finance student, what should be first step to understand the market and the short term, long term cost? There are so many. I was not prepared for these kind of questions, but I think one of the books that I read very early on in my during my before I start investing or starting my investment career. So there was one book that I read, the One Up on Wall Street. Again, you will not find a lot of books which are written for an Indian context, but the good part of the investments is that the basic philosophy around stock picking remains the same, right? Especially if you are a value investor. If you're momentum or some other kind of investor, then this can be a bit of a. But yeah, so that was one of the books that I picked up. These days, you can go through, you can try to read, say, personal finance dailies. Not a lot, but yes, do keep an eye on them. So I did that initially during my when I was just starting out, not even as an investment advisor, but when I was when I was out of college, not even in this field. That's what I did. So One Up on Wall Street, Rich Dad Poor Dad by Robert Kiyosaki. That's one book that I really like. That changed my way of how to change the way I thought about money in general. So I think that could also be good. Plus, there are enough vlogs these days, Mahek, that you can go through and you know identify script or Mustafa Sheikh. I'm not the right person to answer these questions. I know it's a long topic. I may not be able to answer. Vansh asks, are good fundamentals penny stock? I don't know. So first of all, I mean fundamentals may seem good to you, but yes, if you can objectively establish that the fundamentals are good, anything is good, right? So not just penny stock. See, do not try to get rich quickly. That is one of the bigger problems that we have. That's why a lot of people go for derivatives. They want to buy options, sell options, indulge in futures trading, and that's why they lose a lot of money, right? If there is one entity which has made 5,000 crores, right? We all had the example of Jane Street, right? In 1 year, or I mean 40,000 crores, right? 5,000 is the withheld amount. Now that money has come from somewhere. Somebody has made that money from you. So we have lost, they have won. So the odds are stacked against you. So those things I think you have to really think to. Do not. I mean, the biggest problem is that we try to get rich, and we try to get rich quickly. Nothing wrong with either of them. But if you try to be there very quickly, you might lose a lot of money. Jyoti asks, which is the best long-term portfolio? Jyoti, I cannot answer this question. You'll have to perhaps use a judgment here. Right? You have to look at your risk profile, financial goals, and then decide. I laid down the framework in terms of asset allocation, sub allocation, core satellite, and the regular rebalancing, and accordingly you have to answer. I have an NPS wherein I have 50% allocation to equity. This is question of Japesh. 30% to government securities. How should I classify this? Again, a judgment call. From what I've seen, uh, I will probably put this in core. Again, my judgment, because some of the when I've seen NPS portfolios, they tend to be large cap focused, right? They tend to be large cap focused, so probably I would put the equity portion of the NPS portfolio in the equity in the core portfolio. But again, that's my judgment. Government security is debt. So again, you can think, so government securities, if these hold long term debt, then you can think of it as part of your satellite portfolio, because then there will be interest rate risk if it is short term debt. But I assume, but from what I've seen, this tends to be slightly long term debt. So from the perspective of debt portfolio, 30% government security will most likely classify as satellite portfolio. What is habit funds? I'm sorry, I'm not aware, Vansh. Um, Amrita asks, if you're doing a regular SIP in mutual funds, we keep rebalancing that to around five. Yes, you keep reviewing. So I mean, see, rebalancing is usually between asset classes. That's where the maximum amount of value comes. I mean, rebalancing from your core equity portfolio, satellite equity portfolio will not deliver you the kind of value that perhaps you are looking for. I think it's more about yeah allocation to different kinds of assets and rebalancing between them. SIP is just a way to invest. Eventually, what you see, acha, by investing a 10,000 per annum for next 5 years, my corpus has grown to this much amount, and and then you decide how to rebalance. In which condition we can average? Do not again, that was the entire idea about rule based asset allocation, that you leave it to the you leave it to your rules will tell you when do you average and when do you not. Chandrasekhar asks, I've been investing gold bees. I cannot answer specific questions. I'm sorry, Chandrasekhar. But yes, exposure to, uh, bellwether index. I mean, so as I see, you have two indices, two ETFs, both different asset classes, equity and gold. They should be decent, but again, the point is it sufficient? So you're investing, a certain amount per month. More than anything else, you have to see if it is sufficient. So, if possible, please increase some details about structured products. Different forum, Anil. It will take a lot of time. But yeah, see, DSL bros are not, frankly, they are mostly prepared for HNIs, right? And I've never found any any significant value in those kind of products. But yes, are fund of funds more expensive? Amit asked, yes, those are more expensive because they have dual incidence of course. Can I keep 100% equity portfolio if my horizon is 30 years? Ranjit, I think we have tried to answer this question. I will not do that. And I don't think you will be able to do that as well. I mean, the 100% equity portfolio is fine so long as the markets are doing well. When the market struggle, you'll probably revisit these choices. Can you give an example course that no, I cannot do that. I'm not allowed. Aritra, I cannot answer this question. This will be against SEBI regulations. Asset allocation across the assets percentage. Yeah, look at your risk profile, Jaywalan, and accordingly decide. Yeah, what is a balanced portfolio could be for me could be an aggressive. What could be an aggressive for me could be could be a conservative portfolio for you. So it depends. Um, CFP certification, yes, clearly, Harsh asked, yes, it is good. I have not done CFE, but yes, it will really, if nothing else, it will clearly help you, build your skills around financial planning and how to think about investments. Yearly rebalance on a specific data is good or rule based? It could, Shankar, it could be anything. It could be yearly rebalance. It could be a threshold based rebalance. It could be a mix of two. 52 week high, 52 week low. See, it's complex. The point is the more time and mental space your rules take, the less you will be inclined to stick to those. So the rule should be simple as well. So 52-week high pay I will rebalance, or 52 low I will rebalance. Yes, you can do that. You can do that, right? But I'm not sure. Even by doing that, will you be able to, you will end up with drastically different results compared to using a simple. So that's why I also mentioned simple beats complex, right? By using a simple rebalancing, which could be, let's say, calendar day rebalancing approach, you could do just as well as very highly optimized rebalancing approach. Mutual funds and stocks, which stocks are better in portfolio? Jyoti B, I don't know. I cannot answer this question. Anil, I am bit aware of SP. I'm not. I don't understand the question. So I think you are asking about SIP. In SIP, you invest a particular amount in a fund every month, and just keep doing that. During redemption, who are the buyers of units? Mutual fund AMC buys it from you. And essentially, they just sell the units. I'm talking about the mutual funds. ETFs, it's different. In ETFs, the buyer could be an investor like you. How do you find? I don't know that. You lose for say SIP. Swarna, difficult. Yeah, different forum. I'll number of stocks. Yeah, don't have more than 10, 15, 20 stocks. Share in the same. Index funds prefer to. Sahil, I can spend 5, 10 more minutes if you have time, or should we close now? I'm okay with answering questions.
Yes, sir, yes, sir, you can go.
Sahil, can I take time, or you have to close?
Yes, sir, you can take more 5 minutes.
Sorry?
You can take more 5 minutes.
Okay, so I'll take 5 minutes. I'll try to
Yeah.
answer as many as possible.
Yes, sir. Yes, sir. Please.
How can we help our investors to review and reconstruct the present investment portfolio, which is more. See, what is more important? That is what I don't know. So if you're an advisor, or say, let's say, a mutual fund distributor, this what is important is safety, liquidity, volatility, or return. Now, this is something that we have to ask the investor. Sometimes investor may not be able to answer this question properly themselves. They may not know. So everybody wants good returns at a lower volatility, right? But that does not always. I mean, yeah. these things may not go hand in hand. So the investor you have to judge what investor wants and accordingly construct the portfolio. Is SIP more profitable or lump sum is more profitable? It depends on the market trajectory. It can go either way, Aranjita. Sachin, right approach for 60-year-old to invest and withdraw and go more. Sachin, sir, I think this is a slightly difficult question. I think you should approach. So many things are possible, for 60-year-olds. It depends on the size of your portfolio. What are your expenses during retirement? What do you want from your portfolio? Uh, 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 how big a multiple is your portfolio of your monthly expenses. So it's a function of many things. So I don't think I can answer this just like that. But yes, if possible, do reach out to a finance professional, an advisor, RIA, or if you're just looking for products, you can also reach out to a distributor. That person should be able to assist you with this. Which is the best method to assess the risk appetite? There are tools available for this. You can use those tools. Online tools are available. Some of the online platforms also give you some sense of risk appetite. But eventually, see, uh, you can judge when starting out. You can judge your risk appetite, right? But there are few things that you learn with experience. So you might think that you're an aggressive investor, but over a period of time, you might see, oh, no, perhaps I'm not that aggressive. Perhaps by working with a very aggressive portfolio, I can, I'm perhaps not able to sleep peacefully during nights. Right? The best portfolio for you is the one that lets you sleep peacefully at night. How to hedge the portfolio? So see, hedging hedging is one way is that you sell or you buy put options, but let's not go there. The point is, I know you work with rules. I mean, Sensex has gone 20x over the last 20 years, right? So if you just keep hedging, hedging, and hedging, you will probably miss out on the a big portion of the upside. So you have to see what kind of drawdowns you are comfortable with, Harshad. And accordingly, you take those bets. So if you believe that, okay, I probably cannot lose, more than 20%, I cannot see it draw down 20%, then construct your portfolio accordingly. Allocate to the various assets accordingly. Grish asks, who is running SIP? Grish, yes, you may be investing 10K, but debt funds you may also need debt funds for certain short-term requirements, debt funds, RDs, FDs. So you may need how much stocks are enough for one account. Again, depends. Per person, I'll not be comfortable more than 15 to 20 stocks in the portfolio. Name any book which uh, while starting out, right? I read One Up on Wall Street by Peter Lynch. You can perhaps try this, Manoj. How can I find core stock for the long term? I don't know myself. Pick up a good quality stock which will show you, which you expect will grow with the as perhaps as much as the Indian economy, nominal growth. Between Nifty 50 and active blue chip fund, which is better, having a multi cap, multi asset. You can consider Narpat, you can consider all of these products, but how you do it? Yes, Vansh, I think 5 years experience criteria has come off, but I need to check. Yeah, I mean, yeah, factor funds good. Yes, I use some of them in my portfolio construction, but yes, you can use them. But again, uh, do not put. I mean, do not dive headlong. Have some allocation. See if you're comfortable with that. Give, invest for 5 4 5 6. So invest in the small amounts over a one full business cycle. One thing that we always have to, Nutan, we have to see about any investment strategy, right? If an investment strategy does well all the time, investors will pile in money in that fund, and the alpha that fund offers or the strategy offers might shrink, and that can offer with factor funds as well. See, factor funds may be new to India; they are not new to foreign markets, right? And the experience has been that sometimes the alpha that these factor funds seem to deliver may shrink. So you might want to see. When the mid and small cap rally happens, should one book profit and rebalance the portfolio? Yes, go by you. If your rules say that you should book, you should book. See, first of all, if you have this question, na, Shelly, that whether I should sell or no, just to keep you again, to keep your mental sanity intact, sell a small portion of the portfolio. Let's say you can book, let's say, sell 10% of your mid and small cap portfolio. At least when you do that, na, at least that gives you some comfort. Even if the markets were to fall, you can take, relief, or find comfort in the approach that, okay, even though the markets fell, I was able to book profits, right? And I I was able to sell at a high. And if the rally continues again, you took out just 10 rupees out of the 100 bucks that you had in the portfolio, the 90 will still keep going up. So yeah, it depends, but perhaps I would do that. To each his own. There's no fixed answer. How can we divide our savings into investments? Investing foreign stock works, and how can we invest? Long topic. You will find many articles on this. So there are foreign equity ETFs, fund of funds, index funds available in India, which can give you exposure to these foreign stocks. You can also send money to foreign brokers and invest on there, or you can also take the gift city route for investments. Narpat, I cannot answer this question. If Warren Buffett has sold a lot of stocks right now, should we also follow same and continue investing in index funds? I don't know, Anju. Um, yes, I know there is and no one before Warren Buffett. If he's doing something, perhaps he sees something that the other investors are not seeing. But yes, yeah, up to you. When there are 10 or 12 mutual funds, how can we do rebalancing? Have a low number of funds, Sanjay. Amrita, I'm not a mutual fund. This is a disciplined investor. There's no Amrita. You'll never get objective answers to for this. Never, never, never. Sir, I asked how much expense do you recommend investment as a company for upgrading? Vansh, yeah. Until you feel confident of managing relationships on your own, you try to work with an work under an investment advisor. How to exit even after say 15% to municipal stalls? Ah, how to exit after 10% short term? See, this question is very difficult to answer. So as I said, again, you could have rules. So for instance, you could say, "Acha, I'm putting say 1,000 rupees. When the market grows 20%, I will take out certain portion of that money, right? And then gradually you plan your exit. So if let's say the markets rise 20%, uh, you take out 20% of your portfolio, right? And then you can also move your stop loss slightly higher. Then if it again moves further 20%, you can, let's say, take out another 20% from there. So accordingly you can play this, but there are no right or wrong answers to this. If you have conviction that is strong, you continue. I mean, if you're saying that you want to take out money after 1 2 months, then clearly you do not have a lot of conviction. So I think which tells you that you do not want to, you should not be in such a stock for a long term. SW debt fund recommend SW should ideally be from a debt fund, Mr. Patton, right? SW, in my opinion, should not be from an equity fund. If somebody says it is an equity fund, in my opinion, it is not the right approach. SWP should always be from debt funds, or mostly from debt funds or funds which have very high allocation to debt. The reason is that if I mean you should be running SWP from a fund where the funds are less volatile. India is soon going to have its own gold pricing strategy. One nation, one rate. Will it affect? No, not much. It will only make harsh. It will only make life simple for us. Should I just take the cost on retain rebalance units? That's one way of looking at this. But the problem is, how do you make long term money if you just keep selling all the time? About rebalance, do you remember the debt funds? And yes, you can keep some firepower in debt funds and take advantage when the. Says, can you suggest any codes for MBA finance? Um, there is CFA, there is CFP. I assume you are asking about specifically for learning about investments. CFA and CFP might be decent courses for this. How much stocks is enough for one account? I have no. Nikhil, I'm not sure what your question is. AI is catching up. How many satisfied? Oh, yeah. So essentially, I know you're asking. Deepesh, will AI take up your job? Possible, it might take up my job. I cannot be too lax about this. See, I think financial advices. I think one of the areas where I believe I might be wrong here, where AI is still has a lot to catch up, is on the relationship side. See, investing is not just about picking the right set of investments. It's also about handholding the investments, investor, right? Carrying through them thick and thin. When the markets fall, people get uncomfortable. So, as an advisor, you have to see, is AI the right, or any AI enabled system the right will be the right person to assuage investor concerns? Perhaps yes, perhaps no. In my opinion, that is where, as an advisor, you can add value, right? So I think, yeah, I'm an individual investment advisor as well, and this is a problem. And I do foresee that as a risk to my profession. But yeah, you make AI part of your life in terms of how you do your own research, or rather use it as part of your own learning. Perhaps not for advising clients, but yes. Mr. Amitav asks how a person should sound portfolio, no option, debt loan, investment SIPs, active plus passive, precious metals. Amitav ji, I cannot answer this question. It is not allowed. But yes, as I said, think about risk profile and allocate accordingly. I cannot answer this specifically, right? If you're an aggressive investor, perhaps you can have more into equities, but yeah, accordingly. You see. Clearly, since most of your money is anyways in equities, so it debt. So I think incremental money can go to equities, but then I don't know how much you have in debt. And again, work with an advisor, Amitabh ji. These are complex questions, right? These are not the questions which could be answered on a public forum. You reach out to an advisor who can assist you with these queries. Of course, there'll be some cost attached to it, but yeah, you'll have to see how much stocks. It has come many times in Nikhil. I think 15-20 is enough. What is your opinion about system? No, Iram, I like systemic transfer plans, especially if you have to, if you have a big lump sum and you have to transfer that to equities, or if the equities are at a very high level and you have a lump sum to invest, you can put money in a debt fund and then you can start a STP too, debt funds. So when can we say it buyer of the share? There is no guarantee. Once if there's no liquidity, then you might face issues in selling your stocks, and that sometimes happens with less liquid stock, small cap stocks, and that's where this market impact also comes in. How frequent do we revise the portfolio? Vijay Raghavan asks. Vijay, again, no fixed answers. You can, if you're young, you can perhaps do this every few years. If you are slightly older, you can do this every year, or you can even use a threshold-driven approach. But I think every 12 to 18 months is a very healthy compromise. How should I allocate my B's investments? I think you're referring to Nifty B's, and but yeah, I didn't get a question. CFP certification is good. Trust can invest in mutual fund. So many rules around this. You'll have to check. Trusts are allowed to say invest in select mutual funds, not all the mutual funds. Should plan for better return rather than Neelkant ji said. Will Singh should plan. So yes, everybody should plan for better return. The point is, I know there is no free lunch. Better returns will come at a higher risk. As an investor, can you live with that risk? If you can, then yes, you can. You can think. Equity funds are not a replacement for FDs and SWPs. So I think this is something which is, I think, some of the influencers, social media tend to make things tend to show that things are easier. You just invest in equity fund then in SWP. That's not how we should do. Most likely, you will get worried, or you will get extremely uncomfortable at just about the wrong time, and you will lose a lot of money. Here, I'm not sure of your question. You didn't discuss about different mutual funds in the yeah. So yeah, this could have been this presentation could have taken it with very different direction, but I didn't want to speak about specific categories. But yes, there are multiple types of equity funds, debt funds available in the markets. The point is, how do you view them, right? So there is core portfolio where I said you can use index fund, the satellite portfolio where you can use your your judgment. You can express your portfolio preferences, and then you see. I'm sorry if you believe that there were shortcomings, but yeah, I I specifically did not want to go in that direction. Why do investors mostly redeem their investments very asset before the end of the investment horizon? Keep you holding, and you have to ask those investors. Yes, I think the so first of all, I know insurance products tend to have certain lock-ins which are not easier to exit. But yes, I'm not sure if that is indeed the case that where investors sell their in redeem the investment, especially SBIs before the end of the investment horizon. But I think you're talking about investors who are just about to retire or have just retired and they want to de-risk their portfolio. I think from their part, it's a wrong approach, right? That you're retired does not mean you do not need equity in your portfolio. You certainly need equity, but yes, depending on the size of your portfolio, you might want to take a call on how much is that how much allocation do you want to equity allocation in the portfolio. What are your role as an investment advisor to curb the in these cases to curb the liquidity bias? I think first thing you do is that you create sufficient liquidity in their portfolio. So let's say somebody, if you keep all the money in very risky assets or sort of liquid assets, then the investor will also feel uncomfortable. But if the investor knows that okay, I have the money for next 4 or 5 years, you could use a bucket based approach where you maintain liquidity for the first 5 6 years of retirement, or at all times you keep liquidity for the next 4 5 6 years, right? If that is the case, I don't think investors will bother too much about liquidity. Shomita asks, what is your take on SIF? See, it's a very new offering. No, nobody's even come out with an SIF. Once they come out, we'll see. But yes, it could be part of your core portfolio if you believe that such a product. Again, it's a way of satellite portfolio is a place to express a portfolio preferences. If you believe that there is a product which will be a right fit with what I want from your satellite portfolio, you could do that. Ayushi, lump sum SIP, nobody knows, to be honest. It depends on the market trajectory. Intraday investment, most likely not. I don't know. I don't do that. But yes, Satnam Singh ji, it may not. I mean, I personally don't. See, at when we are thinking about compounding, right? At one end, we are talking about intraday, movements and selling, selling on 2%, 3% gains. That's not how I think. Perhaps I'm not the right person to answer these kind of questions. You might want to engage with an investment advisor or a research analyst firm which specializes in intraday calls. Don't fall for influencers or those telegram channels. That's where you will most likely lose all your money. And private credit AIF safe to invest. Um, I don't like such products, to be honest with you. Too much risk. Puneet, this was a question. Again, perhaps my opinion or my bias, you could say, could be stemming from my lack of knowledge. But somehow I'm not very comfortable taking a risk with my fixed income portfolio. If I have to chase 20% returns, I'll probably go to assets which where the risk and reward angle is much more clearer, right? At least with equity portfolio, I know that I can lose money. Private credit AIFs, you might believe that okay, you will not lose money, but then you can lose a lot of money. Again, I don't know much about this. Personally, I will not do that. The 100 minus age rule is relevant to mutual fund allocation. It depends. Unsure, I'm not sure. You may use that. I think you are talking about equity and debt allocation. But yes, you can do that. I mean, see, rules could be whatever you want to be. The point is that you stick with those rules, right? 100 messages, I think, is not a bad bad rule, to be honest, right? So you could actually take that approach, yeah. But again, this is not advice. This is not investment advice. This is just off the cuff opinion based on what you asked. So if you want 3 4 assets in a portfolio, initial phase of investment, what could be that asset good for the portfolio? Kajal, if you are young, clearly you can invest in an aggressive portfolio, provided your risk profile permits that. Choose assets, choose funds accordingly, choose stocks, whatever, right? So construct a portfolio accordingly. I cannot answer this question, in the open for no, not in the open one. I mean, there are restrictions in terms of, I cannot take specific names. I like STPs. Puneet, long-term investment, middle sector suggestive. Puneet, I cannot answer this question. Anil, not SIP with structured products. Personally, I don't like structured products, but yes, to each his own. If you have no, yeah, so structured products may be structured in multiple ways, right? In terms of liquidity, in terms of some linkage to market returns and all that. See, uh, at some point in time, you also have to look at the taxation part of it, right? So sometimes some structured products might fit in with your tax profile, or how you want your investments to be taxed. Perhaps for you, but yeah, I feel highly uncomfortable in going with. I mean, I prefer simple, right? So PMS, AIFs, right? Structured products, at least not my cup of tea. Perhaps for others that may be okay. Even long term is risky. Why still they recommend to invest? AIR. Karthik, I'm not sure if I got your question. Large cap stocks for long term. Kotanda Raman, sir. Yeah, I mean, depends. I mean, there's nothing that prevents you from investing in short term as well. So it's not short term. I mean, for in mid and small caps as well. Open on system STPs I like. Nifty 50 10 year safe. I don't know, but if India does well, I would expect the Nifty 50 is good, Joel. Vansh, I think we answered this question. Good mutual fund. How to differentiate? Very complex. Mohawk, you'll have to read up on this. But yeah, see, focus on. I mean, there are few things you have to focus on. You have to focus on, risk at look at the sharp ratios, look at the rolling returns, not just the point-to-point returns. Look at the fund manager category. Do a bit of research on the investment style. Read their prospectus. Read their, not the prospectus. Prospectus will be difficult. Read the brochure, right? What exactly is that? What they are doing, right? So accordingly, you can see. Is digital gold a form of investment or physical gold or both? See, digital gold in the in the pure play sense is slightly unregulated. I will not suggest that you use that. If you have to use digital gold, I mean digital, if it is gold mutual funds or gold ETFs, you are still okay. If it is SGBs, you are fine. Physical gold is fine, but there is also another form of gold which is called digital gold, which you can buy invest through multiple platforms. I will not suggest that. Not because they are it's wrong or right. It's simply because they may be they may not be properly regulated. What is regular direct plan? Regular plan is a so every mutual fund scheme comes in two variants, regular and direct. In regular plans, you invest through an inter through a mutual fund distributor, and clearly you need to compensate that distributor. So in the regular variant of the scheme, the AMC pays commission to the distributor on your behalf, and that's how the distributor gets compensated. You can invest in direct plans suo motu on your own if you're DIY do it yourself investor, or you can invest in direct plans on the advice of an investment advisor. But clearly, everybody has to be compensated, right? So if you're taking advice from the investor, from an investment advisor, build those costs in as well. My biased opinion, I'm an investment advisor, right? So for smaller portfolios, perhaps investing in regular plans might be more cost effective for you. Once your portfolio gets bigger, I think direct plans, you could save a lot of money by investing in direct plans. But again, do not discount the cost of advice, or the cost of or the value of support that your mutual fund distributor or an investment advisor can offer. What is the maximum returns we can expect from the market? Read a bit on the. You'll have to read up a bit on the when the market is. Thank you, Deepak. Can bitcoins be good investment option for long term? This is a difficult question. See, it depends, So Bitcoin could be one of those alternative assets that I spoke to you about, right? See, it's not about whether you're investing in Bitcoin or no, right? So Bitcoin, of course, you also have to look at the tax part of it. The point is the size of the bet. So let's say if you're investing, say 0.1% of your portfolio in Bitcoin, it does not matter, right? You can invest. The point is, if you're, let's say, investing, 15%, 20% of your portfolio in Bitcoin. No, that is complex, right? So small amounts, everything. I mean, small amounts will not even make any difference. It is the size of the bet. So you'll have to go back later more on Bitcoin if you want to invest there. You'll have to, develop that comfort. Acha, what is possible, what is not possible, and then you make that judgment call, right? Yeah, many people are using Bitcoin as a long-term investment option, but yeah, you'll have to decide for asset allocation for 27 years for aggressive risk profile. I think. Again, so now I cannot answer this question. I cannot put specific numbers to this, but clearly you can work with an aggressive profile. No, easily I think somewhere between 50 to 70 or perhaps even more. I don't know. That depends. You say you are an aggressive investor. Until I'm sure. Yeah. What is the view on forthcoming investment option? I said I'm excited about this, but I'll have to wait for the offering. See, eventually SIF, unless they are offering anything special, they are not too different from say mutual funds. So mutual fund is also portfolio stocks. If SIF is just that, no, I am not sure how it is different from say something like a mutual fund. Again, SIF size could be small, so that can give a lot of flexibility to the fund manager. But yes, eventually deep down it's a portfolio of stocks, unless they are unless they take advantage of other relaxations. So can you do NSM course or CFA? CFP is best. It depends on what a purpose. If you want to see, it depends on what line you are. I mean, CFA, CFP are very specialized professional courses, right? If you want to be, if you want to professionally be part of this investment industry, then these courses will help. In any case, an NISM course, if you want to be investor professional in India, you have to do an NISM course in some way or the other. There is no way other way out. You have to do that. Contango, Subi, this is futures methodology. Perhaps you can search on the so there's backward, there's Contango. I don't want to get into this right now. Once we have discussed this question, chronic illness bring to make expensive emotion. Mohammed Farhan, I think if you foresee that there will be a lot of expenses in meeting expenses, then clearly you need to keep the liquidity with you. Right? Liquidity is very very critical. Yeah. So yeah. Thanks, Girish. Much I'm not sure what you're asking. Voice AI, I don't know. Retirement advisor. Sunil Bharji. Okay. Financial educator.
Hello, sir. Sorry.
Yeah. I think most of the questions have been answered here. Let's see, repeat. ULIP's good for long term 30. Yeah. Depends, if you have low cost ULIP, you might do as
Yes,
well.
sir.
Yeah. Crypto as an asset class, Nishal, depends. Possibly, yes. The point is the size of the bet. You have to take that call.
Hello, Dipesh, sir.
Mutual fund distributors can't advise, neither they have expertise like. So see, I think it will be wrong for me to say that RIAs are better than MF distributors, and they have better knowledge than them. I'm sure there are many MF distributors who are not only smart but are also wise. Right, wisdom comes with age and experience.
Hello, sir.
It depends. Yeah,
Hello.
yeah, yes,
Yes,
I.
sir. Are we good to end up because it's already 5:30?
Yeah, yeah, please, yeah, yeah.
Yeah,
Thanks, thanks everyone for joining this webinar.
yeah. Thank you so much, sir, for we are having means sharing your knowledge and expertise with us. You are,
My pleasure.
yeah. Thank you again for and wonderful. Wishing you a wonderful day. Thank you.
Sure. Thank you so much. Thank you. Thank you. Bye bye.